I used to own a prop firm that eventually got acquired by a different prop firm. In this video, I want to show you how to get started with futures prop firms with some unique behind the scenes insights to essentially give you a head start. To give you that head start, we are going to dive into 5 things. The first thing we're going to go over is a common question, and that is, are prop firms a Ponzi scheme? After that, we're going to dive into the data on the difference between winning and losing traders. After that, how to survive each stage, how to go from evaluation to a payout. After that, the one thing that creates more winning traders, which is also data backed. After that, we're going to end it off with which prop firms are the best ones to start off with. Quick disclaimer, the information that we are going to discuss is specifically relevant to new traders from the US, Canada, the UK, and also the rest of Europe. First topic, are prop firms a Ponzi scheme? No, they're not. But I'm going to explain you as an ex-prop firm owner myself, the perspective of the prop firm and how understanding that will also help you. With prop firms, you pay a fee for an evaluation. That might be $100 a month to eventually acquire, for example, a $50K account. If you pass that evaluation of that account, eventually you have the chance to also get paid. So you get a percentage of the profits that you make on that account. So how does that actually work? Well, of course, majority of the profits that are made from the prop firm, they are made by losing traders. So if the trader pays that evaluation fee, they fill the account, then they lose the money, they need to start over again. So you can imagine if a lot of people, a lot of traders do that, and a lot of them fail as well, that's a lot of revenue for the prop firm. That also brings us to the first thing you should understand. Prop firms would like it if you fail. And the reality is that the majority also fail. Again, the easiest way to generate revenue for the prop firm is simply if you fail. That doesn't mean that it's impossible, because it's definitely not. And we're going to dive into the data in just a little bit on what is the difference between winning and losing traders. Now, what that does mean overall is that prop firms are going to have specific rules in place. The majority of those rules are actually in place for the prop firm to try and prevent people from gaming the system. So to try and find loopholes and then gamble their way to, for example, a payout. So most firms, the majority of the revenue that they make comes from failing traders, essentially. But most firms also have a risk management team on the back end. So that means that if you do pass an evaluation and you do get payouts, they have a risk management team in place to see how well your risk management is, how well you are actually trading. And if you do well enough, your trades will essentially be copied as well. So because they are mirroring, they're copying your trades, that also means they make money from that. Important to understand, the moment you do pass an evaluation, it's not like you immediately get copy traded, because that's just too much risk on the prop firm side. So usually after a couple of payouts, for example, then they'll start to evaluate, okay, how's this trader doing? Can we copy their trades? Now, what I just mentioned regarding risk management and that the prop firm can potentially copy your trades, that's quite important to understand for the next part of this story. Because what the prop firm doesn't like is when you try to game the system. So when you throw risk management out of the window, essentially, as a trader, and what that exactly means is something we're going to dive into. But if you just start gambling your whole account with full risk, because that's what a lot of traders try to do, they try to game the system and try to find loopholes to eventually get payouts. That's what the prop firm doesn't like. Now, there's a couple of reasons for that. Of course, you could argue, well, if they try to gamble and they're going to lose, then isn't that just better for the prop firm itself? So what's the problem? And you're not wrong, but there's also a small percentage of that will make it through to the payout stage, and that will get these large one-time payouts, and then eventually they might get banned. And the reason why they get banned from the prop firm is because, again, like I just mentioned, if you have proper risk management and the prop firm can eventually copy your trades, then they'll do so. But if they can't copy your trades because you're simply gambling, then you're too high risk. And if you're considered too high risk, well, then essentially the only option that they will have is either limiting your account in such a way, so oftentimes they will also warn you, you need to stick to certain risk management parameters, or they'll just simply ban you. Now, of course, you could make the argument, well, that's not right. And yeah, I can somewhat see that, but at the end of the day, the way you can really see this, it's a relationship between the trader and the prop firm. As in, they can give you the opportunity, they can give you the access to actually achieve payouts, to start scaling your capital, as long as you don't do anything crazy outside of those rules. Then it becomes this win-win scenario between the prop firm and the trader. But if the prop firm feels like you're just taking advantage of them by gambling with full risk, etc., then the prop firm will take serious actions as well. So that's quite important to understand, because oftentimes there will be people that mention, I've been banned from 6 prop firms because I trade too good. That's just inherently not true, because if you're truly that good of a trader, the prop firm won't really ban you. Oftentimes when traders say that, that just means they got banned because they got to pay out in an unethical manner. So the prop firm had to take serious action. Now, whether that's ethical, unethical, morally right or wrong, I'm not here to discuss that. But I'm just here to say that prop firms, they do provide you with that access. And if you try to take advantage of that, that's not good. So I think we should approach it in a certain way, which I think is the best way to build a long-term healthy relationship with these prop firms to scale your capital. So next, what we're going to dive into is the data on the difference between winning and losing traders. So these are the main differences right here. Now, first of all, again, we have the factor right here, the passed accounts and the breached accounts. So the passed accounts is essentially the winning traders. The breached accounts is the losing traders, so that breach their accounts. First of all, we have win rate. For winning traders, that's usually anywhere from 60 to 80%. But in general, it's important to understand, it's generally speaking above 50%. Again, you don't necessarily need a crazy high win rate to make trading work for you. But if you combine it with the risk to reward ratio, which we're just going to dive into in a second, that is important to understand what your win rate actually is. So right here, for the losing traders, this is generally low. And what that means is below 15%. Now, having a win rate of below 50% is not necessarily a problem. What is a problem is combining that with risk to reward ratio. So for winning traders, this is anywhere from between 2.45 to 2.54, which is very good if you combine it with the win rate that they have. So that means that the winning traders, if they risk $100, then they can only lose $100. But at the same time, if they win those trades, then on average, they win $245 in total profit. That combined with any win rate above 50% is really good, is really solid. Now for the losing traders, again, you don't necessarily need to have a high win rate, but if you have a low win rate, and on top of that, your risk to reward ratio is anywhere from 0.56 to 0.97, which we see in the losing traders, that's not good. Because that means if you are risking $100, then they on average are making $56. So that is half of what they are risking. Now, you could probably see the problem that if you have a very low win rate and you only make $56, if you're risking $100, you need to have an incredible win rate to compensate for that. So a low win rate in combination with a negative risk to reward ratio, that's not ideal. That's not going to work out. Now, how you can approach that and how you can improve that as well is all things we're going to dive into. Next, right here, stop loss and take profit. So for winning traders, they simply use a clear stop loss level, so where they get out of the trade, and a take profit level, so where they essentially, take profit and they get out of the trade as well with profit. For losing traders, they don't really tend to use that. They ignore it. So it's ignored by many. So that also means that losing traders oftentimes leave on losing trades. They don't go out of the trade. They don't minimize their risk. And instead, they hope that eventually it might turn into a winning trade. Now, if we move on to the next, that is contract size. So how much these traders are actually risking on every individual trade. For winning traders, this is adjusted dynamically often. So that means that they're not risking 2 contracts on every single trade. No, sometimes it's a couple of micros, sometimes it's 1 mini, sometimes it's 3 minis, depending on the overall scenario and how much they can risk as well. For losing traders, you probably guessed it, that is the complete opposite. So many use constant sizes. And what that means is that they'll always, for example, risk 1 mini, but on every single trade. So even if for example, the stop loss is larger or smaller, they always risk 1 mini. So what that means is that the risk management is overall just not there. If we take a look at the preferred trading strategies of winning traders versus losing traders, then we see for winning traders, this oftentimes is a mix of arguably everything. So for amongst the winning traders, there are swing traders. So that means that they hold it for a longer period of time. There's also intraday traders where they're, like it says, day trading. They hold for a couple of hours, for example. And there's also controlled scalping, where they might have very quick in and out trades on the lower time frame. So the exact method of how long they generally hold, whether that's for throughout the whole day or whether that's only for a couple of minutes, that in general doesn't really make a difference between the winning traders. But they all have something in common, and that is risk management. So when we for example, mention scalping here, we mention controlled scalping. If we head on over to the losing traders, they will most likely trade also in a scalping method, but mostly scalping with no discipline, no risk management. So basically what they tend to do, they go into the lower time frame, they just risk a whole lot of contracts on a certain instrument, and they just go all in essentially. So when I say the majority of prop firm traders, they also fail, majority of the prop firm traders also have simply no clue what they're actually doing, following very basic guidelines. If they were to follow very basic guidelines, they would do a whole lot better. Moving on, the number of trades per day. And this is an interesting one because this is going to tie into something that we're going to talk about in a little bit as well. For winning traders, this is oftentimes between 2.5 to 3.15 right there, trades a day. If we compare it to losing traders triple that amount. So that's anywhere between 7.8 to 8.61. So not only are losing traders scalping on the lower time frame with high risk, essentially with constant contract sizes, on top of that, they also take the most trades per day whilst they have no idea what they actually are doing and what they should be doing. So that's, of course, this whole recipe, that's a disaster. That's a recipe for disaster. This then also correlates to the following: the average duration of an account. So the average duration of an evaluation. For winning traders, that's oftentimes 9.4 days right there. For losing traders, that's 5 to around 7.17 days. So how long it takes for losing traders to lose their account is maybe a week. And that's, again, the combination of all these things. So if you trade a lot in a day, if you have a high risk, if you have a low win rate, then of course, you don't need a whole lot of time to blow through these accounts. So what exactly can we learn from this, and how can you apply this into your own trading to get started with these prop firms? That's where we're going to dive into how to survive each stage. So I'm going to split that up into, well, mainly 2 stages, right? So you have the evaluation stage. That is when you pay the fee. You need to pass the evaluation. If you pass the evaluation, you're going on to a funded stage. And that funded stage is where you have the chance to eventually get to a payout as well. The way I oftentimes see it, and as a trader myself as well, because I've also passed evaluations, I've also gotten payouts, so I'm not just an ex-prop firm owner, is that oftentimes it feels like you're trying to figure out quite a complicated puzzle at the start. And when you're trying to figure out quite a complicated puzzle, the best thing you can do is take it easy. Start off easy. So it also means don't go for 100K accounts. No, start off with the smallest account. That might be a 25K US dollar account. And the sole purpose of that is because you start off easy and you just try to get the hang of it. So like that puzzle, you just try to get the hang of it. And when you eventually figure out that puzzle, it becomes easier and easier. And that's where you can start scaling to larger accounts, for example. And it's also a large reason why prop firms are so interesting, in my opinion, is because you don't need to deposit 50K US dollar of your own money into a broker and then try with your own money or all of your own money. So relatively seen to paying 100 US dollar for a prop firm fee, it's quite low, 100 US dollar compared to 50K US dollar to try and learn with that 50K US dollar that you might blow everything. That evaluation stage is a puzzle in itself. The payout stage is another puzzle in itself. So the evaluation stage, why that is a puzzle is first you need to try to get a feel of how you want to pass it, which strategy, which trading plan you actually want to start using. And you'll notice if you first start off with everything that we just went over, you start off with just low risk and you try to get the hang of it, then eventually you'll figure out that puzzle of passing evaluation. When that happens, the ball will start rolling. So the next evaluation will also become easier. But when you go from evaluation stage to a payout stage, oftentimes that's where it gets even more difficult. And the reason why that is because it's more pressure. So from a trading perspective, it's not always more difficult, but from a psychological perspective, it's oftentimes a little bit tougher. And the reason why is because now it feels like you're so close. You figured everything out, you're in the payout stage, and that's oftentimes where trades blow. So let me tell you my own personal story and then also a story of being an ex-prop firm owner and what I saw. My own personal story is that when I passed an evaluation for the first time, I got to the funded stage, and that was my first funded account. I told about it to all my friends, to my family, how happy I was. And what happened is that I never got a payout. I never got a payout from that account. And the reason why is because there was too much pressure to it. I was so close to achieving that payout. There was too much pressure. I started doing things, deviating from my trading plan. And that just led to me blowing that account, where I started ignoring, for example, how much risk I had per day. Then another story as an ex-prop firm owner, we actually had a trader that passed the evaluation quite fast, quite smoothly. Then eventually got to the payout stage. And in the payout stage, they had a balance. So the balance was still open, was still running. They had a balance of $8,000 in profit. All that person had to do was simply close all the positions, wait until they are eligible for a payout, and then simply request the payout. Now, what happened instead is that person got quite greedy. The pressure got to them, maybe the greediness got to them, because they kept trading. And eventually that $8,000 profit that they made, that turned into a loss. And not just a loss, because they completely blew the account at the end of the day. So again, evaluation stage, payout stage. Payout stage is the same, where you're trying to figure out a puzzle and eventually you get better and better at it. So once you get to the first payout, that ball will start rolling and it will become a whole lot easier. Now, what is important, you just start off slow. Whether you are in the evaluation stage or the payout stage, start off slow. At the start, it's just one big learning experience, if that makes sense. It's not there to immediately make a crazy amount of money. Now, this is going to tie in very nicely to the one thing that creates more winning traders. And to fully show you what I mean with that, with the one thing, I run a company that is called Pipback, where we have, as of now, this is a completely free dashboard that you can also start using for your own trading to help you out with that prop firm journey. It's a platform built by ex-prop firm owners where we, for example, have this dashboard right here where you can simply add your evaluations. Let's say you have an in-progress evaluation right there. I'm going to select Apex Trader Funding right there. Let's say the account size is just the smallest that we can have at that moment in time, 25K. This is a one step because you only have an evaluation, then you have the payout right there. The purchase date is today right there. Apex at this moment in time is a one-time fee that might be $20 for that account if you use code PIP. Activation fee might be $75 right there. If I add this evaluation right there, I can actually start journaling, which is very important because that's what we're going to dive into, and I can start getting better at this. You'll see the evaluation. I can move this on to funded. I can also move this over to filled if I want to right there. And that way I can keep track of the accounts that I have within that journey. And eventually, if you start scaling to more accounts, etc., you can simply very easily see which accounts you have, which are in progress, which are planned, etc. You can see your expenses. You can see the pass rate that you have, the profit, the overall net profit, the invested amount that you have right there. It basically tells you everything that you should know about your whole prop firm journey. And on top of that, the reason why this is so interesting and why I did want to share it with you is if you go to your routine right here, you can actually select a certain routine. So what you are going to trade. So what we literally just saw is the biggest reason why those traders lose oftentimes is because they don't plan anything. It's like you're just messing around, if that makes sense. So if you have this dashboard right here, you have a pre-session, I'm only going to trade ES right there. Or I might say, today, I'm only going to trade MES, the micro version right there, so I can take less risk right there. I might click trade today, saved right there. I might select a stop trading time right there, so I actually get a notification as well in my browser right here. I can see the important events. So for example, a Fed interest rate decision right there, CPI in the morning. I can get notified for that as well. I'm prepared, and that's oftentimes what it really is. It's preparation. And then after that, once you are done, you can head on over to the journal right there, and you can actually start journaling your day right there. And why is this so important to understand? Because if we go over the data, and the one thing that creates more winning traders is journaling. That's it. So the data that we have from this is light users, so that don't really journal a whole lot, might do it once in a while, but don't really actively journal. They have a win rate of 44.7% on average with profitable days. So a profitable day is essentially a winning day where they end the day with profit. That is 42.9%. And the trades a day is around 19.7, which is a whole lot of trades. Now, if we move on to the regular users, so the users that journal more consistently, but still not super consistent, they have now a win rate of 49.7%. So that's from 42 to 49. Profitable days is 47.5%, which is also an increase. The trades a day is still high, 20.7. But what is the interesting part, if we now go on to the heavy users right here, this is where it gets very interesting because the win rate now increases to 50.8%. So above that 50% that we were talking about. On top of that, we see that the profitable days right there actually increased to 53.2%. So they have more winning days than they have losing days. The trades a day go to 10.1, which is arguably still quite high. But it's half of what they were previously trading. So what that means is, for example, if I want to journal right here, then, and I can select if I followed my risk plan right there, how good was this trading session overall right there, and I can select the amount, and I can now start journaling right there with images, with my notes. Then what will happen is I will understand what makes the winning trade, what makes the losing trades. So Nasdaq provided a winner at 10 a.m., for example, right there. Okay, if I now save that entry and I have a whole calendar essentially telling me when I take the winners, when I take the losses, then I can do more of the winners and I can do less of the loss because I can actually see this properly. So journaling is the one thing which is, again, quite basic arguably, because that's just like saying, well, eating healthy makes you perform better or makes you feel better. Yeah, of course it does. Just like journaling makes you trade better eventually. If you want to use this, link in the description. Again, this platform as of now, as of today, is completely free. So there's no risk on your side. And then we have which firms are the best to start off with. I would advise to always go for the known firms. And then what are the known firms? Well, the known firms are the ones we also have on pitback.com, where we also have a recommendation tool. So if you're not sure which firm to choose, etc., that tool can help you out which one you should be choosing. You can find discounts and you can join a Discord community as well, where you are joining other prop firm traders and, again, ex-prop firm owners that help you with unique insights and give you updates regarding these firms. Now on Pitback, you can also compare prop firms. So you can see the rules that prop firms have. So you're aware of everything essentially before you buy. Again, this is all free. For complete transparency, the reason why we can make this free is because a lot of people also then tend to use our affiliate code, which is PIP. So if people claim an offer, if they buy an account and they use our affiliate code, that's how we then get paid, for example.